Okay, guys, we're going to move on to the next article today. This one comes from Forbes. So Brian found this one. This is real estate bridging finance, the new star of alternative investing.
Yep.
So I know you guys have this conversation a lot, and this is kind of one of those things like on the periphery of what I read about and what I talk about. So I wanted to make sure that the audience gets to hear from you directly about what this is, how to best apply it, what are the situations you'd be looking for, or maybe this is the best way to finance your situation. So can we start talking first of all about, let's explain to people what bridge financing is, and we'll start talking about some of the benefits of that.
Yeah. So I mean, in the most simplest term, I think I didn't know that there was this many different names for bridge financing. Yeah. I know it as hard money, private money lending. Some of them call it mezz finance. So I'm like,
yeah,
okay,
I never heard that word.
Never heard that one before. Exactly.
Short for mezzanine finance.
Oh,
yeah.
There you go.
Mezzanine. Yeah.
I'm gonna write that one down. I'm gonna use it later.
Yeah.
What it essentially stands for is just a alternate way of financing an investment property, not going through the conventional route being, you go to a regular bank. A lot of these products are used in short term and are specifically just for investment properties. Yeah. So it's a financial tool you use for a short term period to be able to get in, refix a house, or hold it for a rental and be able to profit off of it. So in the most simplest term, it's for investment financing.
Yeah, most people don't know that this is a great tool to utilize to secure a property that you've identified and you haven't sold yours. Mm-hmm. So you're essentially utilizing your equity to bridge the financing into that new purchase, which is pretty awesome to do, right? And so it just doesn't stop there. And the cool thing about the traditional way of doing things, the funds come to you much faster. The qualification is much faster. Most of these you don't need income qualification. You don't need to show tax returns, W-2s, because it's an asset-driven, investment, which makes it a lot easier.
Yeah. And then two of the most typical scenarios that you're utilizing these types of financing for is going to be your fix and flip. When you buy a house, you turn around and sell it for a profit after you made those, additions or rehabs. And then there's the other one where you do the exact same thing, but instead of the end game being a resell or selling for profit, you're actually going to retain that property, turn it into a rental, and get some renters in there, and then recuperate your investment like that. So there's two different routes, and those are two of the most how do I say it, popular ones that you utilize when utilizing this type of financing. And then the other one, like Will said, is when you need to bridge your financing from one sale to the other. Therefore you're bridging it from your old sale to the new loan that you're basically bringing in.
Yeah, no, it's a pretty cool tool.
Yeah.
Everything has its pros and cons, right? Like anything in life. Again, the pros are that you have fast financing, you can secure an asset, that you identify without having to sell your home. They'll essentially give you a loan on your current equity to borrow against the other property. Meanwhile, you're going through, the financing of the regular financing for that next property. So it's not always just for investments. It's for owner occupancy as well. And then it's got flexible terms. A lot of times you can choose to go interest only.
Yeah.
Right? You don't have to go with the principal and interest because it's going to be a short-term loan. Those are the cons right there. The cons is it's a short-term loan. Usually it's going to be only for a couple months. The other thing it could be, it's going to be higher interest rates, because we are borrowing you the funds without really seeing your repayment. The repayment is more collateralized of what your home is worth. So the interest rates are going to be, it's going to be a lot higher because there's more risk. And then, things don't work out. There is a possibility that you could lose the asset if your exit strategy isn't in place correctly.
Yeah, and then one of the things that I'd want to highlight is that on average, the people that are utilizing this type of financing is going to be, investors or people that are constantly, able to take that leverage and know that risk that they're getting themselves into, because obviously every loan that's get written is a risk-based factor how they approve it. So a lot of these people utilizing understand the leverage that they're putting themselves into, but that's the beauty of it, that they're able to take that leverage, OPM other people's money, and be able to utilize it to, quote unquote, arbitrage the difference between what they're currently doing and then the sale of the project.
Yeah, it's pretty wild.
Well, and I know that this is one of those things that at least common right now here in San Diego is people are doing this because they're building that EDU, they're doing the garage conversion. Now, I know that there are cases where, or I don't know if this is a tried and true rule, so you guys have to clarify for me, but if you want to do like construction, it's not the same as a construction loan if you're living in it versus you're going to be building something that's an investment. So is that always, or is that only in some occasions in your experience?
Can you repeat the question?
Yeah, is it because because
I'm sorry, I was looking down trying to think exactly.
What I was saying is in construction financing is different than this because I think what gets confused sometimes, and I've kind of seen some comments about this. That's why I'm asking the question this way. Is for anyone who's watching just this segment, when you're looking at bridge finance, it's not the same as construction financing. In an ADU situation, you might be using those funds to construct something, but it's not ground up on land, and there's no structure.
You know, that's a great question. Here's the thing. This bridge, because it's short term, right? It's usually going to be 6 months to 12 months. Construction, a lot of times with these properties, depending where you're at with the permitting process, very different. So this is going to be more tailored to, you know, like a rehabilitation property. And then you have if it's owner occupied, you're utilizing your equity to rehab your property, and then you're just going to refinance it afterwards. Yep. So that's how it'll work in that case. If it's a property that you're looking, very common right now, it's a word used, novations, that people fix the property to maximize the sale, right? They want to maximize that they're going to sell that property for a higher price. So what they'll do is they'll go ahead and bridge some financing to rehab that property, and the exit strategy would be to just sell it.
So I'm going to pose the question to you guys. I know that this is happening a lot right now, conditionally because of the type of stuff people are doing on their properties. But do you think this is just a fad, or do you think that this is? Meaning, let me phrase it this way: the rate at which you're seeing it being used now, do you think that is going to continue that way moving forward, or do you think that it's just a big blip on the radar right now and it's going to temper off in the near future?
It's been around for decades.
Yeah, I was going to say that.
As long as been, so it's not a fact.
At the level we see it right now is what I'm saying.
I feel that after 2020, when everybody basically, you know, was stuck at home, fix and flip, and money was very cheap at that moment, a lot of people became, you know, quote unquote investors, and they started getting, you know, these ideas through, you know, social media, you know, people posting stuff that they saw online. And I feel in that sense, that's where it really got more popular, or even, you know, even more active to the market. But I don't think it's a fad, because in the article they state that, you know, it's been around for, like Will said, decades. You know, decades. And a lot of these people that are going into these communities are fixing and flipping the properties and making the community better. So I don't necessarily believe that it's a fad when there's an investor that says, hey, this is my territory, I'm just, you know, looking to make this community better. And they stay in that market because they're able to understand it, they're able to work around it, and by that time they know people that they're like, hey, I'd rather just sell it to you or just make business with you because I know you have a track record in this community.
I feel like this should be more common to be able to be utilized, but it's not as easy as it seems, right? So we're probably going to get a lot of calls saying people, hey, I can bridge loan, but that's not the fact. That it's going to cost you money to do this. And then when you have to sell the property, right? And now you're going to incur more closing costs on that other loan. So a lot of people are saying, no, I'd rather not pay, because anytime this is more private money, it's going to cost you anywhere from 2 to 4 points. Right? 4% of your loan, where the traditional mortgages aren't like that. You have to get scrutinized by submitting your paperwork and all that stuff. So that's why we see here, which is pretty cool. I found very interesting that, you know, we got 10% of people, investors, purchasing properties through a fix and flip. I thought those numbers were pretty damn cool, you know? And so that's, it's although it sounds so easy to obtain, a lot of times it's just not, because this, as the article goes through it and we move through it, it's going to also depend on your experience, you know? And so a lot of people don't have the experience of rehabbing. We have ideas, but as we start demoing certain things, we're like, whoa, we just didn't have the right person. You know what I mean? And so that's part of all this equation. You have to show. It's more common when people have a property and they found a property. Let's say they're here in San Diego, and we've done a couple of them where they found a property in Arizona and they have to move, and they don't want to be contingent because they don't want to lose out on that opportunity over there. So automatically, we'll pretty much purchase that property, utilize that equity, and bridge it, put all the down payment here on that next one. It's more common for that.
Yeah. Yeah, and the reason I posed the question that way is because for a lot of people, they're kind of hearing about this the first time. Like, we know it's been around for a long time. You guys talk about it a lot more than I do. You're in the front of it a lot more than I am. But the reason is because I have seen even in just kind of prepping for this topic today, like some people, there's just these misconceptions or these simple misunderstandings because we don't really get down to the core of talking about it until we talk about it, until someone's on the phone with you or they're in the office and you're actually explaining this to them. So I wanted to make sure that we had a time here to actually kind of explain some of these things. And also, this is a huge market. Just kind of my final thought on this is, you know, I think I read here, like back in 2012 was the latest, or 2022, sorry, was the latest number I saw, like $130 billion of bridge short-term finance. That's a ton of money.
That's a ton of money.
That's a lot. Yeah. And if that accounts for 10%, that also reflects how huge the mortgage market is as 10 times bigger than that 130, which is 1.3 trillion, right? Yeah. So 130 billion is a lot of money to lend this way. But it's obviously lucrative because the lenders are making their money, they're making their spread, and they're happy.
Of course.
And the borrowers, as long as they're not getting themselves stuck in a foreclosure situation, they're getting out of it what they need to.
Yeah, this is a great alternative.
Yeah.
And we're starting to see this a lot more. You know, whether you call it bridging or you're doing a fix and flip loan, it's pretty much you're bridging, you know, what you can in financing, alternative financing. So, which is pretty cool.